our ultimate goal is to partner with business owners and make sure that they've got the best information they need at hand when they're making decisions about how to grow their business, where to invest in their business, how to reach their clients, and where to free up the finances to back that up, the programs that they want to implement to aid their business. So what I've brought for you today is part of the initial interview that we have with our clients to make sure that they understand what information that they already collect is right there at hand and what it means. It's a starting point for us to gauge how much they have actually known about their business going into it and where we can help them improve. So I've just taken the basic financial statements and made some comments about what it does tell you, so that it gives you an opportunity, if you use any program, whether it's QuickIn or QuickBooks or some other desktop program, to enter your checkbook and reconcile your bank statement. You have access to all of this information already. It's just a matter of knowing where to pull it out and what it means. The income statement, I think, is one that most everybody understands pretty clearly. It's what are you selling, what is it costing you, and is there money left over at the end of the month? The purpose of this explanation, though, is to help you classify the amounts that you pay into what's a cost of sales, which is a direct cost of doing your business or delivering your service. And the way to judge whether it's a cost of sales or not is, if you didn't have a sale, would you have the cost? If the answer is no, then it's a cost of sales. Then it's totally variable, meaning if you don't have any sales, you don't have any cost of sales. The rest of the expenses that your business incurs are operating expenses, meaning these are expenses that keep your business operating. If you have an office, you have rent, you have utilities, you have a phone, whether you have an office or not, you have internet connection, you have a lot of things that keep you in business. Those expenses occur whether you make a sale or not. So those are your what's called overhead. Fixed expenses that if you're operating your business, you have these expenses with some regularity. So the difference in classifying those is to help you know sales minus your cost of sales is your gross margin. And if there is too small a margin, it won't cover your operating expenses, you're going to operate your business at a loss. So you want to make sure that at the top line, when you're pricing your service or your products, that when you subtract the cost of sales, there's a significant enough amount left over at the volumes that you will establish as your minimum volumes to cover your basic operating expenses. That's a zero-base accounting approach. So you want to make sure, number one, you have enough profit to where if you grow your business, your profits will grow. There's a mistake that's taught early on in accounting classes, and that is if you have a loss leader, a product or a service that doesn't make money by itself, you cannot make it up in volume. That volume concept is just digging the hole deeper. So anyway, this is just a little bit of an explanation.